So what was the probability that Citigroup would go? So what was the probability that Citigroup would go bankrupt or would be nationalized? Okay. You'll find out tomorrow, right? What's the dividend discount model value for Citigroup? I gave you the earnings. I gave you the growth rate. I gave you the return on equity, right? Stable growth model. You come up with 15. If you forgot to adjust for dividends, you're going to come up with 20, in which case, you've overestimated the value of the stock. But that's why the return on equity matters. Stock's trading at 6. Your value of equity is 15. The probability of nationalization is 40%. Actually, let's see, 60%. Sorry, 60%. Okay. Probability that it will not be nationalized is 40%. I shouldn't be doing this, right? So, okay, never mind. You'll get your quizzes back tomorrow. I was going to ask you, add minority interest or subtract minority interest, but I will leave that sore spot alone for the moment. But I want to pick up where I left off with multiples. We're talking about PE ratios. Remind me again, what are the 3 variables that affect PE ratio? Payout / return on equity, cost of equity, expected growth, right? Remember the role playing I was going through? I was playing the role of an equity research analyst. Now I'm going to start off by playing the role of a market strategist. So here's my graph. This is the PE ratio for the S&P 500 going back to 1960. Right? See those lines through, the dark line through? That's actually the average PE over the last 48 years. So that's the average PE. So the average PE over the last 48 years has been about 15.6, 15.7. The S&P 500 at the end of 2008 was trading at about 13.5, 14 times earnings. So let me play the role of a market strategist. And you've probably seen variations of this pitch over the last few weeks, of last few months. I'm going to make the argument that stocks today are undervalued, collectively, because the PE ratio today is lower than the average PE ratio over the last 50 years. So technically I'm right? The PE ratio today is lower than the average of the last 50 years. Am I justified in drawing this conclusion though? Can I compare the PE ratio today, the average over time, and say stocks are undervalued, overvalued? Let's play devil's advocate. You play the role of devil's advocate. Tell me what else could explain why the PE ratio today should be lower than the historic average. Let's go through item by item. We've got cost of equity, growth rate, and return equity, right? Let's take the cost of equity. What are the 2 components in the cost of equity for the market as a whole? There's a risk-free rate, but that should be helping us, right? The risk-free rate now is lower than it's been historically. And what's the other component? The equity risk premium. So already you can see the basis for your first counter-argument. If I assume the equity risk premium is going to revert back to historic norms, 4.5%, 5%, of course stocks are undervalued. But if I make the assumption that there's been a structural break, that the equity risk premium now is much higher than it's been historically, the PE ratio today should be lower than the historic PE ratio. I'm not trying to explain away today's PE ratio. I'm saying it's not that easy. You can't just compare PE ratios across time and draw judgments because it would be the equity risk premium. Let's go to the second input, growth. What's a growth argument for why PE ratio should be lower now? What does growth look like for the next couple of years, 3 years? Collectively, growth in earnings for US companies. Doesn't look good, right? It doesn't look good because the economy is slowed down. It's not just the banks. Collectively, you see earnings declining. And if growth is low, the PE rate, so maybe the growth rate looking forward is going to be lower than it's been over the last 50 years, which could again explain low PE. So it could be a higher equity risk premium, lower growth. And the third input, payout ratio / return equity, is also working against you. The return on equity for US companies has been rising for almost 25 years. Maybe this is a break again. The return equity looking forward might be lower than that historic return on equity, which in turn should translate into a lower PE ratio. Again, my argument is not that stocks are fairly valued or overvalued. I'm saying when you see that story, stocks today are undervalued because the PE ratio today is lower than the historic average, stop and ask the follow-up question. Is that true, or is there something else I should be worrying about that explains why stocks are where they are right now? This is a global phenomenon. The PE ratio in every market has hit numbers we haven't seen in 10, 15, 20 years. And before we jump in with both feet and say, therefore I'm going to buy stocks, we have to resolve at least these issues to make that judgment. Okay. In fact, the two numbers that have historically driven PE ratios in the US have been the level of interest rates, and you can see why that matters, and the term structure. In a second, I'm going to ask you why that might matter. In fact, I went back over the last 50 years and I collected the inverse of the PE ratio, which is often called the earnings yield. It's used by markets, right? So it's the earnings to price ratio. So what you see here as the red line is the earnings to price ratio. The brown line is actually the T-bond rate. If I did nothing else and just presented you with those two lines, you don't need to do any statistical analysis to figure out that they seem to move together. When T-bond rates go up, the earnings to price ratio goes up, which is the same thing as saying PE ratios come down. When T-bond rates have historically come down, the earnings to price ratios come down with it. The other line that you see here is actually the difference between the 10-year T-bond rate and the 3-month T-bill rate. See, you can see what I'm measuring with that, right? That's the slope of the yield curve. When that number is a big positive number, you've got an upward sloping yield curve. When that number is 0, you've got a flat yield curve. When that number is negative, and keep your eyes on those negative numbers, you've got a downward sloping yield curve. So I took those 50 years of numbers and I decided to put it to the test. The first thing I computed was a correlation between the earnings to price ratio and the T-bond rate. And here I got confirmation that I could see in the graph itself. The correlation between just those two numbers, the level of T-bond rates and earnings to price ratios in the US, is almost 70%. That's amazing. If you think about it, half of the variation in US stock PE ratios, saying why half, 0.7 squared is about 49%, so the R squared is about 49%. Half of the variation in PE ratios in the US can be explained by one variable. Tell me the level of the T-bond rate, and I can tell you what the price-earnings ratio of a stock should be. To kind of cement the process, though, here's the final thing I did. I took those 50 years of data, and I ran a regression. The variable that I'm trying to explain is the earnings to price ratio, right? And the two variables that I think matter are the level of the T-bond rate and the difference between the T-bond rate and the T-bill rate. Let's read the regression output. The intercept of this regression is 2.61%. What does that tell me? Not much. It's a base from which I'm going to build off. But let's read this 0.687. What does that tell me? How would I read that? Every 1% increase in T-bond rates increases the earnings to price ratio by 0.687%. I know it's kind of counterintuitive to think about this, but when earnings to price ratios go up, price earnings ratios come down, right? So let's suppose I told you that I think T-bond rates over the next year are going to climb from 3%, which is where they are right now, to about 5%. Point of view. Then I come to you with a question. If I am right and T-bond rates should climb by 2% over the next year, what will happen to PE ratios in the US? Holding everything else constant, you can see the consequences, right? 2% increase in T-bond rates, which means my earnings to price ratio is going to increase by about 1.4%, which is going to translate into a drop in the PE ratio of about 3 to 4. So if you think interest rates are going to go up, this gives you a way of quantifying the impact of higher interest rates on the PE ratio. But you can see the intuition there. Higher interest rates historically have worked against stock prices. PE ratios have gone down. But let's take the second piece of output there. For every 1% increase in the slope of the yield curve, the earnings to price ratio decreases by 0.365%. Let me repeat that again. As the yield curve becomes more upward sloping, price earnings ratios seem to rise. As the yield curve flattens or becomes downward sloping, price earnings ratios seem to decrease. So historically, it looks like the slope of the yield curve has affected stock prices. Upward sloping yield curves have been good for stocks. Flat or downward sloping yield curves have been bad for stocks. Why is that? Yeah. But inflation affects both rates. Why? This is actually relative, right? So when you say short-term rates, inflation doesn't just affect short-term. Why? It's a compounded effect. So if I have 5% inflation every year, unless you expect the inflation to be higher in future years, But this is actually the reverse. Inflation is expected to be lower in future years, right? If your short-term rate's higher than the long-term rate. So if it's an inflation story, it doesn't seem to be in sync with what's happening to stock prices, because the inflation story here would mean that long-term inflation is low, which is after all what we care about in stock prices, but stock prices seem to go down. How do yield curves become downward sloping? What causes that to happen? Yeah.
When you need to stimulate growth, you bring down the interest rate.
In other words, this is the Fed effect. Let me go back and show you the last page, the graph on the last page. Look at when you've had downward sloping yield curves. I'll go through the years in which we've had downward sloping yield curves, and I know this requires a little bit of economic history. Tell me whether you notice a pattern here. Yield curves were downward sloping in 1974. They were downward sloping in 1981. They were downward sloping in 91. They were downward sloping in 2000. You know what happened, right? Each of those periods, the year after, we went into a recession. In the US at least, this is how we've ended up with downward sloping yield curves. The economy overheats. The Fed panics. After the Fed panics, they hit the brakes on the money supply, and short-term rates rise. It's not that the long-term rate falls, but the short-term rates have risen, and you got a downward sloping yield curve. So you know what this is saying is when the Fed panics, it tightens money supply. That's bad for stocks. When the Fed eases up and lowers short-term rates, that's good for stocks. The Fed effect, at least from this 50-year period, is alive in the US. Investors in the US at least seem to believe that the Fed can affect stock prices. You know why I'm saying that? Because in Japan, you know what happened in the 1990s? The Japanese central bank lost all power over the economy. Because what's the mechanism you have for the Fed? You basically play with the Fed funds rate, hope to bring short-term rates down, right? Which is fine if short-term rates are 5% or 4% and long-term rates are 7%. But if your long-term rate is 1%, as it was in Japan in the 1990s, what power do you have as the Fed or as the central bank? Which is what should be scaring the Fed in the US right now. Because what are short-term rates? At least the Fed funds rate is pretty close to zero, right? The Fed has basically used up its ammunition. This is it. I mean, the way to think about the Fed, it's like the Wizard of Oz. No, seriously. We ascribe, have you seen the Wizard of Oz? You know what happens, right? When Dorothy ends up in front of the Wizard of Oz, they think of this Wizard of Oz as a person with gigantic powers. And then you go behind the curtain, and what do you see? A little guy pulling strings. That's basically what the Fed is. We ascribe powers to the Fed that it really doesn't have. So once those powers become, you see behind the curtain, you say, hey, you know what? I thought the Fed could do something for the real economy. It can't do much. Luckily, I don't think we've reached that stage yet, but we're getting pretty close to that stage where the Fed is going to run out of ammunition because it has very limited tools in its arsenal to kind of, it can't go out and produce real output. All it can do, it can't even affect interest rates, right? All it can do is change the Fed funds rate and hope that translates into market interest rates. It can't set the T-bond rate. It doesn't set the T-bill rate. But historically, at least, through the Fed funds rate, it's affected the short-term rates, and through the short-term rates, it's affected stock prices. An interesting question here is, will that continue to hold? Now, what was the question that started this discussion? I claimed that stocks were undervalued today because PE ratios today are lower than they were historically, right? Let's come back and look at that question. Is there a way I can use this regression equation to answer that question? T-bond rate right now is about 3%, right? Plug in 3% into as the T-bond rate. I don't even remember what the T-bill rate is, but it's what, 1.3, 1.4%? You plug in the T-bill rate into that equation. In fact, a week ago when I plugged in the numbers, I think I did do the plugging in. Let's see what I got. I might not have done it all the way through. No, I didn't do it. But a week ago when I plugged in these numbers, I got a predicted earnings to price ratio, given where the T-bond rate is now and where the T-bill rate is now, of about 4%. So help me out. Given the level of rates today and the term structure today, the earnings to price ratio should be 4%, which translates into a PE ratio of 25. Stocks are trading at 12 times earnings, 13 times earnings. If I believe this regression, I should be buying stocks like crazy. Again, implicit in this regression, though, is the assumption that equity risk premiums have not changed systematically. So when you see this big debate between people saying stocks are massively undervalued and people saying they're not, What they're really debating is really the equity risk premium number, whether the equity risk premium is going to revert back to historic norms, in which case stocks are definitely undervalued. Or if they're not going to revert back, in which case stocks might be fairly valued where they are right now. So don't compare PE ratios across time unless you're willing to control for changes in interest rates, changes in growth, changes in country risk. If you're looking at an emerging market PE ratio, that will affect the PE ratios you see for the market. Okay? Yeah.
Using your regression, even with historical average, it will be expensive, right?
Will be the predicted PE that I get is 25. The actual PE is 13, right? Which would make it cheap, not expensive. So with my regression, it basically looks like stocks are undervalued by about 45, 46, 47%, which actually mirrors what we did when we did the S&P 500 using free cash flows, and we used a 4% risk premium. We did find that the S&P 500 should be trading around 1,400. Okay, so this actually mirrors what we got when we used a historic risk premium in an intrinsic valuation model. So I got fired as a market strategist after I put out this recommendation. So I landed on my feet. I am now the beverage analyst. And this is my sector. Okay, so there are my companies. Again, I'm going to put out a buy recommendation. And I'd like you to tell me what I might be missing in this buy recommendation. Here are the 3 stocks I really like in my sector. They're Andre Wine. Have you heard of this company? It produces champagne that's so cheap that looking at it gives you a headache. The only time I've actually seen their commercials is before Christmas. It's a guy in a sleigh drinking Andre Wine, and then, I don't know, I think he passes out. You never see him again. Okay? But it's really cheap champagne place. This is college student champagne, basically, you know, $3 jugs of champagne. Okay? Todd Hunter and Hansen. You see why I picked those 3? What is it that drew my attention to those 3? Those are the only 3 companies that trade at PE ratios less than 10. So I'm using a very naive strategy. I'm saying pick these stocks because they have really low PE ratios. Big buy recommendation. You're the investor. Play devil's advocate again. Pick those 3 companies. They have low PE ratios. Tell me what could explain the low PE ratios. I've kind of given away the game with some of the other data I've given. With Todd Hunter and Andre Wine, what seems to be the culprit? The 3 variables that affect PE ratios are growth, return on equity, and cost of equity, right? With Todd Hunter and Andre Wine, the problem seems to be that they are low growth companies. The PE ratio reflects it, right? But what about Hansen? I mean, it looks pretty good, right? PE ratio of 9.7, growth looks pretty good. So what seems to be the potential culprit there? Look at the risk, the standard deviation. I haven't given you traditional beta, but it looks like it's the most volatile stock in the entire sector. In other words, before I decide that these stocks are cheap, I have to look at the growth for the first 2 companies and risk in the last one, and those could at least partially explain why the stocks look cheap. Again, remember what we said at the start of relative valuation. There's nothing wrong with using multiples if you dot all your I's and cross all your T's. If you ask all the follow-up questions. And here, if all I do is pick stocks based on low PE ratios, I might not be finding cheap stocks. I might be finding stocks that look cheap, but have good reasons for looking cheap. Low growth in 2 cases, high risk in another. Is there a way I could control for that? What is it I'm trying to explain? I'm trying to explain PE ratios. What is it I'm worried about? Risk and growth. We'll come back and talk about controlling for them. But you can already see that the first level analysis of just looking for low PE ratios isn't necessarily going to deliver cheap stocks to you. Let's follow up. I got fired. Yeah, go ahead, Patrick.
I'm just curious, since equity is like an option on the value of a firm.
Only if you're on the verge of distress. Okay? That equity as an option is a very limited. We'll come back and talk about it. Equity as an option, the firm works only if you think about default. I mean, basically liquidating the firm and paying off debt. If you're an ongoing company, if you're a healthy company, equity behaves like any other cash flow asset, right? You have earnings, you have cash flows, you have growth. So there will, if you look at distressed companies, then you might have to worry about optionality. In which case, I think I can see where you're going. Higher risk is good for equity. So if I gave you equity values in distressed telecom companies, then risk might actually be a good thing for you. But equity in healthy companies, higher risk is going to push down the equity value. So I got fired as a beverage analyst after I put that buy recommendation. Here's my new recommendation. Here's my new sector. I'm the telecom analyst. This is my sector. This is way back in time when telecom companies actually had earnings. Okay? So this is my sector. The company I really, really like in this sector is Telebrás, which has since been broken. That used to be the Brazilian telecom company. It's since been broken up into 6 or 7 other small companies. At that time, it was one gigantic company. You know why I like Telebrás? Because its PE ratio is only 8.9. Again, it looks cheap, right? Low PE. One low PE is right there on the graph. It is. Growth rate doesn't look that great. What's the other thing that should worry you when you look at that low PE? You have low growth. What else do you have to worry about? These are all ADRs of telecom companies, some in developed markets, some in emerging markets. This is a Brazilian telecom company in the late 90s. There's a lot of country risk here. So the two things so it's almost like, on the one hand it looks cheap, on the other hand it is low growth and high risk. And you can already see the problem with storytelling. I could talk myself into a corner here. So rather than telling you a story, here's what I'm going to do instead. I took this sector, I ran a regression of price-earnings ratios against a growth rate and a dummy variable. Remember dummy variables in statistics? They take on a value either 0 or 1. So I went through that sector. If it was an emerging market telecom, I put 1 next to it. If it's a developed market company, I put in 0. Help me read the output from the regression. First, R squared of 66%. Is that a good R squared? Yeah. In finance, don't be looking for 95% R squared. You're not going to find it. In fact, if you get to 40, 50, don't look a gift horse in the mouth. This is about as good as it's going to get. So that's a pretty good R squared. Let's take the output from the regression. The intercept of the regression was 13.11. What does that tell me? It tells me very little other than what the sector overall was being priced at then. That's the base from which I'm going to build off. The coefficient of the growth rate was 1.21, which means every 1% difference in growth rates in this sector translates into a difference in PE ratios of 1.21. We talked about quantifying the effect of growth. If you're a telecom company, I'm a telecom company, and my growth rate is 5% higher than your growth rate, you know what this regression is telling me? Your PE ratio should be roughly 6 higher than mine. It essentially goes beyond saying higher growth gives you a higher PE. It gives me exactly how much higher the PE should be. So I've basically quantified the effect of growth. But here's the coefficient that I found most fascinating. The dummy variable in the emerging markets, the coefficient on that variable was minus 13.85. Help me read that coefficient. What exactly does that tell me?
It's penalizing.
Go ahead.
It's penalizing emerging markets.
It's penalizing emerging markets, but this is actually how much it's penalizing. You have two telecom companies with exactly the same growth rate. One is a developed market telecom, the other is an emerging market telecom. At that time that I did this regression, the emerging market telecom company had a PE ratio 13.85 lower than the developed market telecom company. I'll tell you when this tactic is most useful. Let's suppose you go back to, some of you, how many are from Latin America? Okay? One of the problems of doing relative valuation in Latin America is you pick a company in Latin America, you try to find comparable companies, you very quickly run out of the sample. So often what people do is they bring in US companies into the sample. So to value our accrues, they will look at paper and pulp companies in the US, which of course opens you up to a problem. US companies might not have the emerging market risk. So this is what the numbers end up looking like. Aracruz is trading at 7 times earnings. The US paper and pulp companies trade at 11 times earnings, and you're at an impasse. You're at an impasse because you can't jump to the conclusion that Aracruz is cheaper because you haven't controlled for country risk. So the question is, how do you bring country risk into the comparison? And the storytelling can get you only so far. This is one tactic you can use to quantify the effect of country risk. Is you take a big sample of firms, some of which are emerging, some of which are developed, you put in a dummy variable, the data will then tell you what the market is attaching as a discount, and at the time that I ran this regression, the discount was huge. But as we talked about in the context of DCF valuation between 2003, 2004, 2005, this discount became smaller. It didn't appear becoming large again. So no rule of thumb is going to work across time, but updating this kind of regression will actually allow you to quantify the effect. Okay? So in this particular case, what attracted me to Telebrás was the fact that it had a low PE, right? But now that I've looked at the regression, I can actually plug in the numbers for Telebrás. Growth rate of 7.5%, the fact it's an emerging market company, and guess what? At 8.9 times earnings, it really doesn't look cheap. It actually looks overvalued by about 10%. And when I said statistics is the tool that will be most useful in relative valuation, wasn't exaggerating. Because really the problem you face here is you have 15, 20, 25 companies pulling you in different directions. If you start down the storytelling route, there is no way to come to a conclusion. This just allows you to take those numbers and say, this is what the market is valuing growth at. This is what it thinks about emerging markets right now. Let me look at whether my stocks are cheap or expensive given where the market is today. Yes, Madi?
So how should you interpret that standard error of 19.27?
Okay, let's go back. Oh, actually, the standard error should be 0.1927. I'm sorry. That was my mistake, because what I did was I moved the coefficient over on 1 and didn't. Actually, that's a good point. See that 19.27? That should really be 0.1927, because the coefficients came out as 112 point something. I moved one, but I did not move the other. So the reason I know that's wrong is you look at the t-statistic. The t-statistic clearly reflects it. You know how to read the t-statistic, right? When you run these regressions, don't get too focused on the r-squared, because the question you always face is that a high enough r-squared? Rather than think in terms of r-squared, look at the standard errors in the t-statistics. If this regression is giving you any kind of meaningful relationship, the t-statistic should be greater than what? If you get above 2, you're basically looking at statistical significance. If you get about 4 or 5, you're looking at economic significance, because it's far easier to meet the statistical test than the economic test, because you just need, especially with large samples. But look at the t-statistics, and a low r-squared just means when you make predictions using this regression, you get a much bigger range in your prediction. So that 8.35 that you saw as my predicted PE for Telebrass actually has a range on it, right? Because given that the r-squared is not 100%, if I quantified that, the range I might get might be 7.9 to 8.7, whatever it is, which then allows me to pass judgment, at least given that range, as to whether I'm still within the range or outside the range. So rather than think in terms of r-squared, think of this sort of the range widening if your r-squared is low. Any questions? So if you're working with a sector where you have a mix of developed market and emerging market companies, try this tactic out to get a sense of what emerging market companies are being discounted by the market after controlling for other variables. In fact, this is the broader strategy. If you have banks, for instance, and your price-to-book ratios for banks, you might want to control for the risk that the bank has, subprime, securities on a mispriced security, toxic as. I mean, you can basically define risk whatever way you want on the sector that you're working with and try to bring it into the regression and see if that explains differences in pricing across companies within that sector. Now, in all the examples that I've used so far, I've pretty much stayed within a sector, right? Telecom companies, beverage companies. But once you start controlling for differences in growth and risk and cash flows, there's no reason why you have to stay sector focused. The only reason we compare software companies to software companies is because comparing software companies to utilities is difficult given the differences in growth, differences in risk. But that's exactly what the regression is controlling for, right? Differences in fundamentals. So once I start controlling for differences in cash flows, growth, and risk, there's no reason why my comparable firm should not include every firm in the market. Do you see where I'm going? Why stay focused with these small samples of 15 companies or 20 companies when I can compare your company to 3,000 other companies and control for differences between your company and those companies? So the start of every year, in fact, I try this out. I take every company in the US, every company in emerging markets, every company in Europe, every company in Japan, and I take each multiple and see if I can use the entire market to come up with a relationship between that multiple and variables within that market. So let's start with the US. Let's start with PE ratios. Let's say your job is to predict PE ratios for companies. You want to run a regression of PE ratios against fundamentals for US stocks. What are the 3 variables again that affect PE? Cost of equity, growth rate, and payout ratio, right? Which of these 3 variables, at least in conventional wisdom is, which of these 3 variables should be most critical in explaining differences in PE? Growth, risk, or payout? Story I've heard with PE usually is a growth story, right? So here's the first thing I did. I took every US company for which I could get a PE ratio. The reason I'm saying that is, remember, all the companies I lost in the process of trying to compute a PE ratio. Then I took each company and I got the expected growth in earnings for that company. and I put it on a scatter plot. Basically, in a scatter plot, you have the PE ratio on one axis and you have the expected growth on the other. I have some good news and I have some bad news. Here's the good news. Higher growth companies have higher PE ratios. You know why that's good news, right? Because that's a conventional wisdom. At least it seems to be okay. See what the bad news is? This is not exactly a strong relationship. This looks like a shotgun blast in some places. There's a lot of noise. There are a lot of low growth companies, high PE ratios, high growth companies, low PEs. You know why I did this? Because I don't want to get my hopes up too high. In what sense? I'm going to run a regression of PE ratios against growth, payout, and risk, right? If your strongest variable is doing such a bad job in explaining PE ratios, you can already see what kind of R squared you're going to get on this regression, right? Remember that 66% R squared? You're not going to get even close to that. In fact, when I ran the regression, this is what the R squared looked like, and it didn't surprise me. So this is across all US stocks, PE ratios against growth, payout, and beta. The R squared is 29%. Am I happy with that? No. But this wasn't my weapon of choice in the first place. I wanted to do discounted cash flow valuation. You are the one who kept jumping up saying, PE ratios, let's use PE ratios. You know what this regression is showing? It's holding up a mirror to the multiple saying, this is not that great a multiple. In fact, as we go through price to book, price to sales, you're going to see the R squareds improve with book value and revenue multiples. Of all the multiples, price earnings ratios are the toughest to explain. They have the most noise on them because the denominator earnings tends to be the most volatile of the variables. Yep.
Is it not R square is low because you're taking across sectors?
But when I show you the price to book regression, you're going to see 70% R squared. It's not there. I'm doing the same thing. I'm going across sectors. I have a much better chance of explaining differences in price to book and price to sales ratios, even across the market, than I do with earnings multiples. So it's not just because I'm running across the market. I have two things working for me. One is a huge sample, which is going to push up my t-statistics and lower my standard errors. So it's not necessarily because I'm running a market regression. It's earnings multiples in particular where you're going to run into this problem because the denominator, the earnings number, if you know, tends to be very volatile, which causes the PE ratios to kind of jump around, which makes it much more difficult to explain an individual company's PE ratio.
But I mean, if you, like you said, you can break down into that.
Even within sectors, try it out. Take a sector of just beverage companies.
No, I'm saying you said that you can break that into intrinsic value. Every multiple has an intrinsic value.
Right.
So if you use that argument, book value, any multiple should have the same parameters.
That's not true though, because what happens is because your book value and return on equity, you can normalize those numbers. You have a much better job because the market price is based on normalized earnings, right? So even if your earnings drop, if your book value stays at $1 billion, the market's going to say, well, the earnings are going to bounce back. Same thing with revenues. So markets price based on normalized earnings. But what we're actually using is actual earnings here, which I think is the potential problem that causes these regressions to a much lower R squared. So R squared of 29%. As I said, don't read too much into it. This basically means that this regression, when used for predictions, is going to give you a much wider range of PE ratios. One thing though, this is not a kitchen sink regression. You know what a kitchen sink regression is? We've all been guilty of that in statistics classes. Where, what's our objective? What do we want our regression to have? High R squared, right? So we sit there and we start adding variables to the regression to make our R squared goes up. The reason I'm saying it's not a kitchen sink regression is I've stopped at 3 variables. And the 3 variables I picked were not randomly picked. They were not picked because they gave me the highest R squared. They picked because they were the variables that popped up when we did the algebra. Cost of equity captured with the beta, payout ratio, and expected growth. I stopped there. If I wanted to, could I make the R squared on this regression higher? Absolutely. You allow me to throw variables in there. I can deliver a PE ratio regression with an R squared of 90%. Here are some of the variables I might throw in. I might throw a dummy variable as to whether it's a technology company or a non-technology company. Maybe technology companies have higher PE ratios, even after controlling for growth. Maybe I'll throw in the weight of the CEO. Who knows? Maybe companies with fat CEOs have high PE ratios. You see, once you open this box up, there's no reason why economic rationale has to stop you, right? You want a higher R squared, you're going to throw everything in there that improves the R squared. But that shouldn't be your objective. You're not trying to explain away differences in PE. You're saying how much of the differences are there because they should be. Because whatever differences are there for random reasons, because you have a fat CEO, because you're a technology company, shouldn't be there, right? That's what we're trying to take advantage of. So we want to stick with just fundamentals. And if you want to use some other proxy for risk, I can live with it. But stay with a risk proxy, a cash flow proxy, and a growth proxy, and see what you get as a R-squared. So this is a traditional multiple regression. Let's read the output from the regression. There's a constant. This is the January 2009 regression. The constant is 7.62. That's the base from which I'm going to build off. Every 1% increase in growth rate increases my PE ratio by 0.77. So right now, if you have a 10% expected growth rate, that translates into an increase in your PE ratio of 7.7. Every increase of 1 in my beta knocks down my PE ratio by 5.37. And every 1% increase in my payout ratio increases my PE ratio by 0.08. In other words, 3 variables now, I essentially have numbers I can plug in. The only thing, though, is I don't know how much you remember of your multiple regression lecture in your statistics class. There are some statistical issues in this regression that are still unresolved. Here's one. I don't know, when you run a multiple regression, you throw in independent variables. Remember what's supposed to be true across the independent variables? They have to be uncorrelated with each other, right? What are the 3 variables I'm using? Beta, growth, and payout ratio. Do you think they're going to be uncorrelated with each other? Let's go through. When you look at high beta stocks, do they tend to be high growth or low growth? High beta tends to go with high growth and low payout, right? In other words, these variables are not uncorrelated with each other. They're horribly correlated with each other. And in fact, in statistics, it's called multicollinearity. Something I never quite grasped again in my statistics class. I said, who cares? Until I started running these regressions, and now I can see why I should care. You know why multicollinearity matters? Is what does the computer see? It doesn't see growth. It doesn't see risk. It sees 4 columns of numbers, right? Let's take an extreme scenario. Let's say all your high beta stocks have high growth rates and low payout ratios. The computer is going to get completely confused about what you're measuring. Your beta might become a better measure of growth than risk. Your growth might become a better measure of risk than growth. In other words, everything starts becoming a proxy for everything else. So rather than having proxies for growth, risk, and payout, you have these 3 variables that are proxying for everything. Here's the bottom line, though. Multicollinearity by itself should not stop you from using the entire regression. You know what it's going to do? Those individual coefficients you see on the variables, don't read too much into them. You can often get the wrong sign. This year, actually, I got the right sign on all 3. You know what I mean by the right sign? The sign on growth should be positive. The sign on beta should be negative. The sign on payout should be positive, right? If you believe the theory. When I've done these regressions over the last 20 years, betas had the wrong sign in at least half of the regressions. Wrong sign in the sense you often get a positive coefficient on beta. And people say, oh, how come higher risk stocks have higher PEs? Well, the reason is we have high beta going with high growth. Beta becomes a better measure of growth than risk, which in turn completely throws the regression off. So don't stop multicollinearity from using the regression, but don't read too much into those individual coefficients because they can get skewed by the multicollinearity. Second, I've assumed a linear relationship between each of these variables in the PE, right? Every time you run a multiple regression, that's what you're doing. And as we saw when we did the hypothetical company, as growth changed, you notice that the price didn't change proportionately. So in reality, we know the relationship is not linear, but because it made life easier for us, we used a linear relationship. Third, if you compare my January 2008 to my 2009 regressions, it's like night and day. Very different numbers. Every coefficient changes, and that's the reality. When you do relative valuation, as the market shifts, the regression will shift with it. Which from a pragmatic standpoint will mean if you're trying to price a stock today and you use a 2008 regression, I'll predict to you even before you put the numbers in that it's not going to work for you. In fact, I'm not even sure the January 2009 numbers will work for you today because between January and March of 2009, so much has changed. So if you're going to do relative valuation, you're going to use this approach, you want to kind of keep updating the regression to make it the most updated numbers you can because you're pricing your stock as of today, you want a regression as of today. Now to just show you the multicollinearity problem, here's how the easiest way to see if you have a problem is to take the variables you're throwing into your regression and do a correlation matrix. Okay? If this regression were a perfect multiple regression, what should this matrix look like? What should the numbers that fall off the diagonal all be? They should all be zeros. That's a good multiple regression, because that means your dependent variables are basically uncorrelated with each other. But look at the numbers. In fact, anytime you see stars next to it, that means it's statistically significant. Take growth and beta. High growth companies have high betas. High growth companies have high payout ratios. Okay? So basically, because your independent variables are correlated with each other, you are going to get that noise that you in your coefficients, which can make the coefficients sometimes have a wrong sign. Not in this particular regression, but sometimes can lead to the wrong sign. So let's say you run this regression. You got an equation in front of you, right? I come to you with a stock. In fact, let's give the stock a name. I come to you with del. I give you the numbers for del. I said del has an expected growth rate of 10%, a beta 1.20, and pays no dividends. And I say, well, you run this market regression. Can you tell me what del's PE ratio should be? What are you going to do? Well, let's actually go back to the regression. I think I've actually worked it in Oh, that's the old regression, sorry. Never mind. Somebody have a calculator and can help me out? Let's plug the numbers into the regression for So here's what we're going to do. We're going to take this regression, we're going to plug in del's numbers. In fact, we could probably do it in our head. The constant is 7.62, right? Somebody with a good math mind, hang in there with me so that we can do this. What's the growth rate I gave for del? 10%? 10% of, with that coefficient, basically will translate an increase of 7.7 in my PE ratio, right? So 7.6 plus 7.8 is going to give me 15.4. 15.4. So keep track of that number. What's the beta that I gave for del? 1.2? Was it? Okay. 1.2 times 5.4 is 6.5. 6.5. Okay. So that's 15.4 minus 6.5. Now we know why they invented calculators, I guess. Is 8.9. Luckily, payout ratio is 0, so nothing to do with that. So if I trust this regression, the predicted PE for del should be 8.9. It's actually trading at 12 times earnings, which makes it undervalued or overvalued. It's overvalued by about 35%. You can see that you could be a one-person hedge fund, right? Do you see how this would work? You take this regression, you get a predicted PE for every stock in the market. Then you compute how much below or above the numbers are. Obviously, because it's a relative valuation, for every del, there's got to be another stock on the other side that's undervalued by a third, 40%, 50%. You take 100 stocks that are most undervalued, the 100 stocks that are most overvalued. You buy the 100 most undervalued stocks. You sell the 100 most overvalued stocks. Then what do? You kneel down and pray that what happens? That all the numbers move towards your regression line. Because if they don't, you don't make your money. Hey, it's going to work at least as well as some of that storytelling here at these hedge funds. It's driven by the numbers. It's relative valuation carried to its logical extreme, right? Because relative valuation, why do we stay with these 12 company samples or 15 company samples? You look at the entire market, you use the regression to come up with predicted PE ratios for every stock, compared to the actual PE to make a judgment. Yeah? Right, but when you do a regression output, in addition to getting a predicted value, what else can you get? We tried this with Minitab. Right? You can get an upper end and a lower end. So anything that falls within the band, you ignore. Look for only those P's that are above and below that line. Okay, we'll continue.